Today's conversation is about perspective and maybe even a bit of a mindset change. We're going to challenge how progressive dairy operations are thinking about the next 6 to 18 months, particularly in a time when the biggest risks aren't always the most obvious. We'll connect the dots between the broader economy and on-farm decisions, and we'll look ahead at where the industry is going and what that means for staying competitive.
Welcome to Compeer's Ag Edge, brought to you by Compeer Financial. In each episode, we break down complex agricultural economics, policy dynamics, and farm business topics into conversations that make sense for your operation. We're here to help you stay informed and confident about the trends and decisions affecting your agricultural business.
I'm Lori Fetzer, Director of Dairy at Compeer Financial. I'm joined by two great voices in the industry, Corey Geiger, lead Dairy Economist at CoBank, and Megan Roberts, Ag Economist at Compeer Financial. So Corey and Megan, thanks for being here. So let's start with a quick introduction from each of you.
Thanks for having me, Lori. As Lori mentioned, I'm an ag economist here at Compeer Financial. I grew up on a dairy farm. My family's still dairy, so I always enjoy getting to talk about dairy, although I'll be honest, I have transitioned industries and I live on a hog farm, still in livestock, and I spend a lot of time thinking about corn and soybeans, as well as the overall macro economy. So I'm excited to talk about what's going on in the macro economy, and there is quite a bit. And I'm also excited to hear more about the dairy economy from Corey. So Corey?
Corey Geiger, lead dairy economist with CoBank. I've been part of CoBank now for 3 years. Prior to that, I was editor at Horde's Dairyman for 28 years and only the sixth person in 140 years to lead the editorial team for the publication. Very involved in dairy. Our family was sixth-generation dairy farmer. My wife's family was the first to put robots in the United States 26 years ago. Past president of Holstein USA and chair of the education committee at World Dairy Expo, and also a board advisor for Dairy Management, Inc., which is the national dairy checkoff funded by the nation's dairy farmers.
Fantastic. Well, thank you both for doing introductions, and I'll say an early congratulations to Corey as well for being named World Dairy Expo 2026 Industry Person of the Year. So that's a great accomplishment for you and a big win for the industry to have you in our back pocket as well. So let's zoom out for a few minutes. Before we get into dairy specifically, let's try to understand the importance of the broader environmental and economic shaping these decisions for dairy producers today. So I'm going to start with Megan. Megan, let's start high level. So when you look at the next 6 to 18 months, what are the economic signals that matter most for agriculture right now?
Yeah, this one was hard just because I think right now, the here and now is so greatly impacting the 6-month outlook, the 1-year outlook, the 18-month outlook, that it's a little bit challenging to disentangle them. But I went with geopolitics in general. Certainly right now, we have some major economic factors that are influencing our macroeconomy. And it's happening right now, but I think those impacts are going to continue into 6 months from now, just because of how long it's going to take to unwind things like the impacts of the Strait of Hormuz being effectively closed. I think we've got some major geopolitical aspects still happening on the tariff side. That hasn't been the number one thing we've been talking about. When we think about this July, the USMCA review occurring and what that could look like 6 months from now, 18 months from now, that's definitely on my radar. And then that leads into my next 6 to 18 months thing, which is what's going to happen with prices and inflation. And that in many ways relies on my geopolitical answer. And then further out, how do prices and inflation affect then the interest rate outlook, which has changed for me just a few months ago. I had a very different interest rate outlook, and I think we're going to talk about that a little bit more in depth as we move further in, but certainly just 6 months out from now, we are likely going to experience a different rate environment than what we thought we were going to be in.
It's definitely not a shortage of topics, is there, Megan? That's for sure. If you had to pick one signal that producers should really closely monitor and pay attention to, only one, what would you choose?
This one was hard for me because I always am someone that says every farm is unique and has their own individual economic situation. And so it's hard to just pick one out of all the things that are happening. But I kind of went to, since I work for a lending institution and farm credit, I went to the interest rate outlook and inflation. If we are able to maybe unwind the current outlook, which is for higher inflation and therefore likely less moderation of rates. If that switches back to where we were before, I think there's opportunity there. So that's where I kind of ended with, that's the one thing to look for if you had to pick one thing.
Perfect. Corey, I'm going to switch to you. If we translate that specifically to dairy operations today, what feels most important to you right now for progressive operations to really be focused on?
Well, I'm looking at dairy markets and specific consumer demand and international demand. You know, Megan talked about the USMCA being up for renegotiation. When it comes to dairy, Mexico is our best customer. 1/4 of all dairy exports go to Mexico, and we're a $9 billion category for U.S. dairy exports, and Mexico is well over 2.5. So first thing I'm going to say is do no harm to that, and it's important to the entire dairy sector. When we look at a baseline on dairy, one of the really big and important things is here, dairy is dynamic and growing. The category is an $80 billion category in grocery and retail based on Circana sales data, and up 3.2%. So if I'm a progressive dairy farmer out there, I want to know I'm in an industry that's growing, and sales certainly are doing that. The total category on a milk solids equivalent, and you're going to hear me say a lot of the word solids during this podcast, or components, because that's what matters most. But total milk equivalent sold in the last year was up 2.4, but January and February were trending higher at 3.7. And certainly part of that is the exports. If you pull exports out directly in January and February, we're up 5.2% year over year. Protein is having a major moment. Upper Midwest progressive-minded dairy producers, the two most important components in your milk check are butterfat, and protein's taken the lead here in the NASCAR race. It's pulled ahead of butterfat. When we look at margins, while dairy margins are holding their own, what I'm saying, we're kind of treading water here right now. Beef is where the major win is in dairy, and that should be, something we can look at for the next 2 to 3 years at a minimum. If you look at USDA economic research data, beef sector, and we got to remember 1 out of 5 pounds of beef sold in this country either comes from a dairy mama or the calf herself from the dairy cow. In 2022, that was an $86 billion in sales, and this year USDA ERS is projecting $133 billion. So weaving beef income, beef on dairy calves, and all that into the bottom line is so important. So there's some really good data we could go through on how that's transformed, but the bottom line here is about 20% of the revenue right now from a really good dairy farms coming from beef calf sales. Now, if you're in expansion mode, get ready, because replacements are in darn tight supply, and 3,100 is the average, and top markets here in the last couple of weeks have been pushing 4,400 for top Holstein heifers. That's a big number. When 2019, you could add choice and privilege for $1,200.
Absolutely. And I think, again, you hit on a lot of key topics there. My next question for you is, where do you think dairy producers are underestimating risk, or where are some of their blind spots? And I probably would have said a couple years, it was really understanding the components, really understanding how your processor was being paid and making sure that you're producing the product that they're looking for, and now we're in a market where some are having butterfat capped. And it's just crazy how the component shift has really happened. What would you say today, here in 2026, is a blind spot for producers maybe, and really understanding what affects their bottom line?
Well, we told dairy producers since 2010, make more butterfat, and dairy producers responded in a very good way. We've gone from 366 butterfat in a national milk tank to a 429. I'm a fan of pay for what you want. If a cheese plant needs more protein, then give the incentive. I'm personally not a fan of the butterfat caps, but I think another risk here is the aging dairy herd. We are definitely getting older. We don't have a perfect data set, but if you look at August of 2023 to August of 2025, we have retained as a national dairy herd 600,000 more cows. We sent fewer cows to slaughter. That now slaughter has picked up a little bit since Labor Day of last year to the tune 80,000, but basically in the last 2.5 years, we've retained almost 500,000 dairy cows. Eventually, we have to pay the piper. We got to turn over our herds. All old cows eventually become hamburger at some point, and that herd's growing to capture the beef on dairy revenue. I get all that, but the question is, how many dairy cows can the domestic and international consumer buy product from? I mean, the herd is really growing because of the beef on dairy movement and high beef prices. And you brought up, Lori, butterfat. U.S. butterfat exports through this March, so first 3 months of 2026 have totaled all of 2024. Our milk prices are in balance right now because we are exporting record butterfat. If something hiccups in there, we could have beyond a big hiccup in our milk checks. But right now, things look good.
Yeah, I think the perspective you bring on the aging dairy herd is a really good one. You know, we've got record low heifer inventory numbers. I know some may not think it's as low as what others are because it seems like if you're planning for expansion, you're planning for growth, you've got that heifer number built in your business model. But to some degree, a little bit older herd isn't necessarily bad. You don't want a really young herd in that first lactation either. There's value in having those cows that are third, fourth lactation. But now we're keeping those pregnant cows because high cull cow value and a really high value for that calf in them too. So you're right. There's a lot less culling because the markets that beef on dairy are providing. But that was a great perspective.
And we have to remind everyone, and I think our smart progressive dairy producers understand that, but it takes a different skill set to get these older cows through transition. It's a little bit different than these first and second lactation cows. So it's something that got to keep on our radar.
I'll maybe just add in really briefly to this conversation that I posed this question to our dairy credit lead here at Compeer, my teammate Erin Dwyer, and she really focused in on the dairy heifer replacement and just the opportunity cost of raising beef calves versus dairy, and that we don't truly know exactly what that opportunity cost is right now because we're just moving through this cycle of beef on dairy becoming a product of a dairy farm as compared to in the past, maybe it was more of a byproduct.
Absolutely. Great perspective. I appreciate that. I could stay on this topic all day, but let's switch back to a little bit of challenging our current thinking, right? Is that it's a great way to look at the big picture environment, the big picture of what's going on. But let's shift into challenging our current thinking, is sometimes that's where our gaps from a management level can show up, right? So I'm going to start with you on this one, Corey. You're extremely well connected to the industry for sure. As you're talking to progressive dairy producers, not even in the Midwest, but in the wide range of producers that you have in your contact list, what do you think their view is on the industry in the next 12 months?
Well, I think we're bullish on the industry. There's really good opportunity here right now. I'd rather be in dairy than about any other commodity right now, maybe outside of beef, if I were just simply a livestock producer. So we're in the right place. But the question is, how do we maintain and grow the category?
Absolutely. Do you think there's any thinking from a current gap standpoint that's too narrow today that we're not thinking broader enough about?
I think when we look at the challenges, I say the rolling herd average needs to rest in peace, and we need to write the obituary on it. Let's talk rolling component average is where we need to be. I was looking at a really good table from the Upper Midwest Federal Milk Marketing, order number 30. They had everybody in 10 percentile groups. So the top 10% was averaging a 4.4 butterfat, 4.44, and 3.38 protein. And the bottom group was 416 and 323. Now, if we took this on a herd, I want to kind of put this in dairy, how I'd talk to a dairy farmer if I was, as we are right now. If we put those percentages on a 90-pound tank average, and everybody can play with them up higher and lower, but that's 0.4 pounds of component difference in the top and bottom group. Doesn't sound like a lot. But if you put that on last year's butterfat and protein, so butterfat averaged $2.45, protein was at $2.44. The difference from the top 10% and bottom 10% on components is 95 cents a cow a day. 95 cents times 365 days, that's $345 per year per cow. That's big time money. And that is why I want to start talking about rolling component average. Those numbers actually at a 90 tank average, if you were at the top 10%, that puts you at 7 pounds of components a day. 7 pounds and just a little bit over. Now, last year, 85% of the bull semen sold in this country was Holsteins in the dairy population. And I know there's Holstein herds that 2-year-olds are averaging the top ones. And I'm talking all the way to the right of the bell-shaped curve at a 5% butterfat and 3.6 protein. I've seen them. So there's a lot of opportunity there on that end.
Absolutely. And I'm going to say you heard it first here on the Ag Edge podcast about rolling component average. So I think people will grasp onto that one and run with it. So I like that. Megan, when you think about the next 12 months, what shifts are coming for your perspective that we want to challenge our current thinking? It could be policy, market or industry related. What may not feel urgent today, but can really impact our operations down the road?
Yeah, so this might be a weird take, but I am going to go back to the United States-Mexico-Canada agreement. I have just a really strong feeling that if we're talking about something that's so kind of under the radar that could have a big impact if USMCA goes haywire, that's where I'm going to go to, because Corey already mentioned it. Mexico is $2.6 billion in 2025 of our dairy exports. Canada's $1.2 billion. You add up that market, it is so important. I thought for our upper Midwest Compeer audience, the numbers for Minnesota and Wisconsin might be kind of interesting. You know, for Minnesota, Mexico, you might think Canada would be our number one export destination for dairy products in Minnesota, but it's Mexico, goes to the south. Canada's number 2, Wisconsin, that flip-flops. And I would say that's a geographic thing. So I hope that the review goes in a good direction, and that I know that for dairy producers, there's some things about that agreement that aren't where they want it to be. And as that process moves forward, hopefully there's positive angles for agricultural producers, particularly dairy producers, and that it can continue on for the duration of its 16-year lifespan, because that is the current lifespan for the United States-Mexico-Canada agreement, unless things go very haywire. And that would have a big impact in my argument in the next 12 months if that were to happen.
So following up on that, Megan, if those shifts do play out, or some of the less desirable parts of USMCA were to be enacted, where do you see them putting the most pressure on a dairy operation?
Well, whenever it comes to export market access, and this was something that a year ago was a bigger economic talking point. Now we've shifted our economic talking points more to things like the energy, fertilizer, oil situation. But that for me is always about commodity prices. And I think it immediately has an impact on dairy pricing. Whether it's USMCA or if things change with, for instance, our China deal, it's really important to have a diverse export market to get our product out into.
Corey, anything you would add to that?
Well, we've come a long way, and we're going to go a long way. If you wind the clock back to 1995, we exported about 2% of our product. Now we're at 17% of our milk solids. And remember, during that time, we grew our milk production 44%. Exports markets are very important to our overall dairy market strategy. So Mexico, again, at almost 25% of our exports, it's our closest neighbor. We have a big advantage on transport. So that agreement is paramount to dairy's future success.
One last thought on this. Well, I just argued for how important Canada and Mexico are, which I still stick to. I will say something that's really great about the last 10 years of dairy exports is that it has increased in diversity of where we are shipping to. And so I think that is a silver lining of any sort of trade discussions, is that there is a more diverse market that U.S. dairy products exit out into.
Perfect. So let's continue to go a little bit deeper, right? So now the real question becomes, how do we actually translate all of this into the daily decisions being made at the operation? So Megan, when you look at interest rates, I think if we didn't address interest rates, we'd have a lot of producers saying, what are you doing? But when you look at interest rates, monetary policy, overall access to capital, how are these dynamics evolving, and what specifically in them should we pay attention to?
Absolutely. There is an evolving outlook when it comes to monetary policy right now and interest rates. Let's start with monetary policy, which is the decisions that the Fed is making. And they're making these decisions based on their dual mandate to keep prices down and have maximum employment. So, on their dual mandate, their concern right now is on the inflation side. And that's a real flip from the last couple of years in which unemployment and jobs growth was the concern. And that is what drove during 2024, the last months of 2024, and then the last months of 2025, what was the grand total of 7 cuts by the Fed Reserve, which adds up to 1.75% off of their federal funds target rate. So labor was driving it. Now we've switched since February 27th into inflation being much more of the concern. And I'm not to say that inflation wasn't a concern before, but we were having this quote unquote soft landing where some of that high inflation was still sticky, still too high, but not the bigger concern. That's changed since February 27th. And it's because we're looking at things like personal consumption expenditures index, which is the Fed's inflation preferred measure, at 3.5%. What does that mean if you're not an inflation follower? Well, 2% is their target. So 3.5 is a bit above 2%. And you have things embedded within that measure, like a 20.9% increase in energy inflation. That's really big. On the consumer price index side, we're at 3.8% inflation for April, not their preferred measure, but it is another inflation measure by the United States government. So it's another good thing to watch. That there's some even more egregious inflation embedded within it, like 54% in April for fuel oil year over year, 28% inflation for gasoline. So enough with the percentages. The key there is inflation for energy related products is higher. At this point, likely not high enough to cause any sort of immediate term rates hikes because oil and energy can be volatile. It's really about if that trend persists in a much longer period of time. We're just in the introductory months of this higher energy inflation. But to tie it now to interest rates, so we did monetary policy. Now we're going to tie it over to interest rates. The interest rate market had been anticipating that the Fed was going to make some monetary policy changes. In fact, they had been anticipating one cut or 25 basis points or 0.25% down in June and one in September. Those have been unwound by the market. And we're looking at the market interest rates, and we're recording a little bit before this podcast comes out, and these rates are literally changing overnight sometimes right now. So I'm going to be a little bit vague and not get too specific here, but in general, we can look at market interest rates and they've come up by about 50, maybe 60 basis points or 0.5% or 0.5 to 0.6% higher since February 27th. And I would argue that is the market unwinding that anticipated 2 cuts, just as we are moving through this inflationary period. The market can go in the other direction as soon as inflation maybe calms down. So I'm not saying this is going to be what it is for 6 months or 12 months. I'm saying this is what is happening right now, and we're going to have to wait and see what happens as we move through this unexpected energy shock.
Yeah, agreed. I'm going to dive into just a quick perspective, I think, from a producer level as to where we're seeing producers actually show up when it comes to interest rate and capital. And then I'm also going to ask Corey for his perspective on how he's seeing capital being utilized and stuff in the industry. When we look at how producers are actually applying the interest rate pressures and capital availability, I think in the Midwest right now, it isn't just about interest rates. It's really about somewhat of a reduction margin for error, right? Margin is always the key word with dairy, but we've come off 5 strong years of profitability. We've got extremely strong working capital, strong cash flows, and producers are being much more intentional now. We're taking a closer look at returns, cash flow, and how each decision is really performing under different scenarios. And we're also looking at how do we manage that interest rate risk? Like, do we pay cash for something versus borrow the money? Whereas before, at cheaper interest rates, 3%, 4%, you would borrow a lot more because it's pretty cheap on the grand scheme of things. From a producer standpoint, I think we're also putting a much stronger focus on maintaining flexibility, whether that's liquidity, working capital, or overall leverage on their balance sheet, because having that liquidity is become a much bigger factor in the environment of how fast the industry is changing and how fast decisions are getting made. When it comes to capital deployment, we're seeing a shift towards investments that drive efficiency, labor, and consistency, I think more than real aggressive expansion plays. Unless the operation's in a really strong position. We still have some that are definitely looking at those bigger expansion plans that have been planned for years. We've got some expansions that we're looking at now for 2028, 2029, and it goes back to what Corey talked about earlier. We got to shift the breeding program, right? If you're going to start making expansion and you had a lot of beef on dairy, now we need to start growing those heifers. And so an expansion is taking a lot more longer to plan out to make sure that your dairy is ready, because of all the factors that we've always kind of talked about. And while strong producers are still moving forward, they're definitely doing it more selectively and with more disciplined assumptions, I think, because essentially what's paying up the loan first is cash flow. And we want to have less volatility in our cash flow than what we've had in the past. And of course, all that's dependent on the partnership with your milk processor and availability and other resources too. Making sure that you have that strong tie and connection is really important as you're looking at deploying capital long-term as well. Corey, again, you've got a wide range of knowledge and perspectives in the industry, but also at CoBank. How do you think capital decisions might look different today than they did 2 or 3 years ago as producers are adjusting to the economics or what the market's providing for them? And do you think that there'll be changes showing up in expansion decisions, technology investments, or just more overall cost management structure?
Let's start with this. A lot of people, I've done a lot of consulting on the bank and different clients. When it comes to places to expand dairy production, a lot of times people talk about a chicken or egg discussion, which comes first. But it's pretty clear where the growth areas for milk are. Dairy farmers need to show that they're willing to grow the milk supply, and the processing investment comes after. Depending on what data set you look at, a lot of people are quoting $11 billion in new dairy plant investment. I say 13 because some of this stuff isn't publicly announced. But the big areas are in this order: New York, Texas, Wisconsin, Michigan, Idaho, and the I-29 corridor, which is essentially Minnesota, South Dakota, and Iowa. And so the theme there is a lot of the production, we could take Texas and Idaho out, but 4 of those other places are very traditional dairy areas with access to a lot of water. Dairy requires a lot of water. Water can be a limiting resource. We've seen peak cow in California in our lifetimes. They'll be the number 1 dairy state for a long time, but they're not going to be growing. That's a positive thing. Now, in some of these regions, land costs are going up, and row crops aren't doing well, but dairy largely is. I grew up in northeast Wisconsin, and I know last month here at a land auction, one 40-acre parcel sold for $21,300, another one sold for $23,500. Some sold privately at $15,000. These prices are driven by nutrient disbursement and nutrient management plans. So the question then becomes, is everybody needs to take a look. If you're a dairy producer, maybe you're not buying land, but if I'm a landlord and I see what the land is worth, that's going to drive up rental prices. I don't see any alternative. I'm a student of dairy. I'm a student of economics. I'm always learning. One of my mentors in life has been Dr. David Cole. And I think one of the statements he's made that I live by, not only running my farm, but talking to others, is marketing is the most important job a dairy farmer can do, or any farmer. And marketing can be, can I afford to pre-buy my fertilizer? Should I sell some of my crops early? What about dairy revenue protection? Where can I lock in a profit? I pre-bought all my fertilizer for my farm in December of 2025, and when I went to pick it up in May, my agronomist told me, well, if you bought this today, it would be up, you'd pay 45% more. Well, boy, oh boy, does that upend the budget. When you look at people wanting to expand, you got to have the heifers once the concrete and the building's up. The ratio of heifers expected to calve has dropped from 30% in 2022 down to 26% this year, and that's based on USDA data. I think there's actually a little less heifers out there. We're going to update our heifer numbers, but in 2025 and 2026, we projected at 796,000 fewer heifers hitting milking strings combined those years. Now we're going to see some improvement in 2027 and 2028 by 360,000. Don't remember the numbers. Heifers are tight, heifers are expensive, and you have to plan. One other thing I'd wrap up, because a lot of the producers in this podcast will probably considered or have biogas. That space has changed a lot here in the last 18 months. There's less support at the federal level. 2020 to 2024 was a big growth area. But, we need more markets. But thumb rule right now is that about 50% of the demand for renewable natural gas, RNG, is from the low carbon fuel standard in California. Well, that's getting pretty saturated. 84% of biodigesters are on dairy farms, so it's a big area. Certainly, we may see a shift to more funding for regenerative ag. I think carbon sequestration, more energy and placement into cover crops and those kind of things. But those are the opportunities I really would sit there and talk about at the dinner table around my barn office.
Yeah, I think that makes a lot of sense. And again, I hope that the perspectives that both of you have provided of how we turn economics into decisions is real great examples for producers today. So let's just zoom out. Again, we've kind of talked about big picture economy, what really matters at the dairy farm, what decisions you have an impact to make today that affect your economic decisions. But let's zoom out and really big picture, where is the industry headed long term? And I know that is a complex question and a loaded question, but this next question is going to be the same for both of you. So Megan, I'm going to start with you. As you look ahead, what shifts, whether it's of scale, technology, regulation, management, what do you think is going to matter most in shaping how progressive dairy operations compete with their peers going forward?
Well, I had one answer prepared for this. However, in the interest of time, just because we haven't brought it up quite as much, I want to mention labor, because I don't think we can have a conversation about progressive dairy moving forward and being competitive without there being a nod to the fact that is a challenge. And for those that are going to stay competitive, we need a great workforce in dairy to keep the industry running.
I think that's a great perspective. You're right, that when you're talking about expansion and competitiveness and all that, labor 100% is a topic that we're always going to talk about on the farm. Absolutely agree. Corey, what are your thoughts on things that are shaping producers' outlook long-term going forward?
When I talk to people in other sectors, peer economists and others in dairy processing too, I start with this theme. The dairy cow is the most researched animal on planet Earth. And why would I bring that up in the podcast? Because last year, we had 2 million genomic predictions run in this country. Since that technology came out in 2008 to last year, we've had 12 million. That means 17% of the genomic tests were run last year. More and more dairy producers that are looking to the future are genomic testing their heifers, and they're kicking the duds out and sending them to second career. And that whole thing is a data theme. It's not the power of the DNA of pulling a root ball out and testing in a heifer calf or an ear punch. It's the 100 million plus records that run that. That's the fuel in the engine. And what's that mean? Data is so important to dairy, whether it's your on-farm data or other things, because you have to make decisions off that data. I wind the clock back 25 years, and I remember my father-in-law, I said, what made you turn to box-style robots? I'm going to prepay my labor. Now, he was in an economic position to do that, but when you add a technology on your farm, you're making a transfer between labor and that technology. And given the tight supply of labor, and it doesn't seem to be easing anytime soon with our tightening of the border, which that's been a goal of the federal administration. They've been very successful at. But then as a business owner, I have to find different ways to get the work done on my farm.
Yeah, absolutely. And I think a lot of times with technology, there definitely is technology that can replace labor. I'd also want to make sure we put a little bit of the caveat in there that it's not always a one for one. Sometimes you'll add technology and you'll just deploy your labor sources somewhere else on the operation or something. And so really like looking at what that investment is not only going to cost you, but what your return is going to be in a very realistic standpoint to be able to see, is this going to replace labor and what other efficiencies am I going to get, is a really important exercise to do for sure before you spend that capital, whether it's on technology or any capital really, of really understanding what that return is going to be. Is there anything that really producers should be leaning into more to stay ahead and be competitive more long term?
I think this one might seem really obvious, but I just really encourage producers to be aligned with their processor. And that is another way to have just a little bit of a competitive edge. And so making sure that your farm and what your best competitive niche is aligns with your processor. And now, of course, sometimes we don't have, because of geography, a lot of alternative choices, but it is something to just make sure you're leaning into what your options are for processing within your local area.
Megan brings up an extremely important point. When federal milk marketing orders, even 25 years ago, they were designed that milk flowed to the highest number. So class 1 beverage was the most important, class 2, 3, and 4. And we've seen class 4 prices pretty consistently above 3 right now. And why is that happening? It's happening because there's a processing plant becomes very specialized and they're very good at making a product. It could be cheese, it could be yogurt, but they're not flowing milk to other product sources like they did years ago. So, is your milk solids in tune with what your processor needs?
Absolutely. 100%. I think that is really well said. As we look to wrap this up, the time has definitely gone by fast. I'm going to do a couple of rapid fire questions for each of you. What's one assumption about the industry that we need to challenge?
I don't know if we're going to challenge it, but we have to double down on it. 90% of the milk in this country is priced on multiple component pricing, everything in the upper Midwest. And almost 80% of our product goes into manufactured foods. And so from that standpoint, I want to double down on the rolling component average. We really got to be talking pounds of solid shipped per day. The water in that milk, unless you're putting it in bottles, is really not contributing to the bottom line for anyone.
I was going to go with protein, which is very similar, if you think about it, to Corey's answer and just components in general. I think that we need to rethink whether our current beef on dairy is going to be a long-term pricing strategy. Eventually, that herd hopefully will return to a more reasonable side, the beef cow herd, and just that the current trends are going to maintain in the way that they are, knowing that we have consumers making different choices at the grocery store with GLP-1s and just some health movements right now. So I think dairy needs to challenge the assumption that our current trends are going to stay into the next couple of years.
Great answers. Last rapid fire question. What is one question every producer should be asking themselves right now?
What does my farm's cash flow look like when this bull run on beef comes to an end? Now, I'm not ringing alarm bells. We have the lowest beef cow herd since 1961 when JFK was president, but this bull run will come to an end. It may be 3 years from now, maybe 5 years from now, and that will dramatically shift revenue.
I kind of had two things. One was like, how am I managing risk in an uncertain environment? And then my follow-up was that, am I doing scenario planning for different market prices? And I had examples, beef being one of them, but then also energy costs, Like, what if we're at $150 barrel oil versus what was expected of 75 at the end of the year? So like, do your scenario planning. It's important.
I tell you, you guys both really hit home for my banker's heart. Really good answers, and I love those last perspectives that you gave our producers for sure. So in closing, as you think about your own operation, the goal is to take what's happening externally and connect it to the decisions that you're making on your operations, while also being willing to challenge your assumptions along the way. Really appreciate Corey and Megan joining us today. Corey and Megan, I know you both have ways that producers can get more information from you. Do you want to give a shout out to those at all?
I'm very active on LinkedIn for those dairy producers that are on there, and I post almost daily some tidbits that are happening in the industry, and that's a good way to keep track of me.
You can follow Compeer's Economic Minute or this Ag Edge podcast.
Yeah, I'd encourage both of you to follow them for some great information, timely information. They've been fantastic to work with on today's podcast. So if you found this conversation valuable, be sure to follow Ag Edge Podcast on your preferred platform. Make sure you share it with others in the industry. Again, I'm going to say one more thank you to Corey and Megan for sharing your time and insights today. And thanks to all of you for listening, and we'll see you next time.
Thank you for listening to Compeer's Ag Edge. You can follow us on Apple Podcasts, Spotify, or your favorite podcast app. For more agricultural finance insights and resources, visit compeer.com. That's COMPEER.com. Until next time.